Hello dear students and welcome to my channel. Today we are going to study a very important topic of capital structure that is known as cost of debt, or we also call this as cost of debenture. At the very outset, I would say that my handwriting is little bad, so you would be getting some issue in understanding the words which I would be writing. So I would request you to kindly manage for today. But our purpose should be to understand this topic better so that you get a better understanding of this financial management. So this topic basically comes under financial management. And in financial management, there is something called capital structure, wherein you have to take very critical decisions like how to raise funds and from where to raise funds. So basically, that also comes under taking financing decisions. Okay. So we will not be going much into financing decisions and investing decisions and dividend decisions, because that topic will be covered in a separate video that I will be making very soon. But for today, we'll try to understand that what is cost of debt and what is cost of debenture, and most importantly, why we are required to study this particular topic. See, I would take a very simple example. Suppose if someone borrows rupees 100, okay? For example, if you borrow this rupees 100 from the bank today, okay? Okay, you would be borrowing this money for some purpose, right? So bank will not be giving you this money for free, okay? That means you need 100 rupees of capital from the bank, and bank has already given you 100 rupees. But in return, bank would be expecting you to pay some interest, right? For example, if bank gives you this money at the rate of 10% per annum, 10% per annum, that means you would be required to return 110 after 1 year to bank. Okay, so this is cost for you. Okay, this 10% is the cost for you. And how do you calculate this cost? The 10 rupees interest you paid on the principal that you had borrowed from the bank. So this comes out to be 10% per annum. Okay, so this is cost for you. Okay, this is cost for you. But at the same time, this is income for the bank. Income for the bank. Okay, so cost for one person is the income for the other person. Okay, so basically this concept comes under when a borrowing and lending of money happens, okay, between two parties. Okay, so I hope you got some understanding of what is a cost for borrowing money from someone. So basically, if you are asked to define this concept in the examination, so you would be defining that cost of debt is nothing but it is annual. We'll be talking this cost of debt or debenture in terms of the annual expense. So it is annual interest expense, annual interest expense paid on borrowed money. Okay, so money can be borrowed in any form, right? You can take loan from the bank. You can also borrow money from the investor by issue of debenture, or we also call this as a bond. So bond and debentures, the features are more or less same. Okay, more or less same. When government issues the bond papers, they are known as bond. But when corporations, for example private entity, when they are in need of fund, when they issue bonds, so they call this as a debenture. So these are nothing but the modern terminologies which are used in the corporates. Okay, so firms, they also raise fund. Okay, they arrange capital. So capital raising capital. Okay, arrangement of fund. Okay, arrangement of fund, or we also call this as sourcing. So all these terms are same. Sourcing of fund can be done by issue of okay, by issue of issue of bond and debenture. Okay, so for example, let us understand that how this works in the market, because until you understand this concept, how money is raised through issue of debentures and bond in the market, you won't be able to understand the formulas that you need to apply in the examination and solve the numerical problems. Okay, so let's understand how a bond works. So in the market, there are two types of bond. For the purpose of understanding this cost of debt and cost of debenture and the formula, I would only discuss two types of debentures in the market or bonds in the market. Okay, I hope this is visible. Let me check that this is visible or not. Yes, this is visible. Okay, so one of the bonds are known as irredeemable bonds, or we also call this as a debenture, and the other one is redeemable bonds. Okay, so basically the difference between irredeemable and redeemable is nothing but the word redeem. Okay, this word redeem has come from the word redemption. Okay, redemption means paying back the principal money which was borrowed initially from the bank or from the bondholder. Okay, for from the investor. Okay, for example, if a firm, there is a one firm A. Okay, they issued one bond in the market, one bond, and they fixed the price of one bond, that is nothing but the face value. Okay, face value of the bond is 100. Okay, that means they want this rupees 100, they want this rupees 100. Okay, from the bond buyer, that means bond investor. Okay, that means if you are interested in buying this bond which is being issued by one of the corporations, so you would be required to pay this rupees 100 to the bond issuer today. For example, you are at time 0, so you would be paying. So think from your perspective. Okay, so you'd be paying this rupees 100, so this will be cash outflow for you. Okay, at the same time, this will be cash inflow for the bond issuer who is raising this fund. And who is the bond issuer? This company A. Okay, now this is known as the face value, that means the price of 1 unit of the bond. Okay, now since this is the principal, this is the bond that has been issued, that money that has been taken by this company A, and since you have invested, you would be expecting some return from this company. So company promises here that if you buy 1 unit of our bond, we will be paying you 10% annual rate of interest every year. Okay, for example, what is the 10% of 100? 10% of 100 is nothing but, if you do the simple calculation, you will get to know. Let me do this here. 10% of 100, 10% of 100 will be nothing but 10 rupees. How you will calculate this? 10 divided by 100 multiplied by 100 will be 10. Okay, so that means you will be getting rupees 100 after 1 year. So this is timeline. Okay, this is the timeline. So you'll be getting rupees 10 here, and again after 2 years you will be getting rupees 10. So bond basically also comes with duration. Okay, that we typically call in fixed income market as a maturity date. Okay, so whenever a bond does not come with any maturity date, that means that will exist forever. The nature of the bond will be perpetual in nature, so that they will be known as irredeemable, means they will not be returned back. What will not be returned back to the investor? This rupees 100. Okay, that means bond will not be redeemed. It will not be redemption will not take place in that bond. Redemption means giving back the principal amount. Okay, redemption. Okay, so that will not be given back. Okay, but if you want to exit from this bond, what you can do, you can sell off this bond to the other investor who are interested in buying this bond, and you can get out of this particular instrument by selling this in the market. Okay, so this is perpetual in nature. The bond which does not have any maturity going forward in the future will be known as irredeemable bond. But the bond which has a maturity, for example, this company A decided to raise this money 100 for 5 years. For 5 years. Okay, 5 years. Try to understand this. If at any point of time you get any kind of confusion, what I would recommend you, just go back and start playing the video again and listen very carefully. If you listen this very carefully again and again, you will understand all the concepts what is happening. Okay, because until you understand the concept of bond, how bond instrument works, you won't be able to get the perfect understanding of the cost of debenture. Okay, so we were in the process of understanding the redeemable and irredeemable. So irredeemable bonds are those which will not have a maturity. But if this company decided to get this fund for 5 years, get this money for 5 years, that means if suppose today is what date? Today is 13th of July, 13th of July 2025. But today is Sunday. So bonds are issued in normal working hours, working days. So suppose a bond gets issued at 14th of July, that is Monday. Okay, and they decided to raise this fund for 5 years. So what will be the maturity of the bond? 1, 2, 3, 4. After 5 years, this date will be nothing but 14th of July 2030. Okay, so 14th of July 2030 will be the maturity date. Okay, 14th of July 2030 will be the maturity date. So bond also comes with maturity date. Okay, let me write this. Maturity date. So this bond will have a maturity date of 14th of July 2030. Okay, for 5 years. That means if an investor has bought this bond, okay, so they will be getting annual income of rupees 1010 for next 5 years. Okay, but at the end of the fifth year, okay, since bond has got matured now, they will be getting their money back. And what they will be getting back? They will be getting their principal back. Okay, so this getting principal back is known as the process called redemption. So whenever a bond matures after a certain period of time, they will be known as redeemable bonds. Okay, redeemable bonds. Okay, since the video is getting little lengthy, what I would recommend you, I'll be making another video. Please watch that video in this sequence so that you get a solid understanding. So in my next video, I'll be talking about the formulas of both types of bond, irredeemable and redeemable bonds. Okay, till then, take care. Thank you so much.